A lot of people think debt cycles end with crashes. That's wrong. Crashes are just the visible punctuation. The real story is what starts after them. And right now, whether markets admit it or not, a new long-term debt cycle has already begun. Not forming, not approaching, already started. The reason most people don't see it is because they're looking for drama. Big defaults, exploding yields, emergency headlines. But long debt cycles don't announce themselves with chaos. They begin quietly with math. And the math has changed. Welcome to Finance Historian. Before we get started, smash the like button and subscribe if you love financial deep dives. Comment your city in the time you're watching this. I want to see how global this community is. For decades, global growth was driven by expanding credit. Governments borrowed, corporations leveraged, households pulled consumption forward. Each cycle ended with a crisis followed by lower rates, more debt, and another round of expansion. That playbook no longer works. Today, debt isn't just high, it's structurally embedded. Governments are no longer borrowing to stimulate growth. They're borrowing to service existing obligations. Interest on debt has become one of the fastest growing budget items across major economies. That's the signal. When debt exists to maintain the system rather than expand it, you're no longer in the old cycle. You're in the reset phase. This is why the term 90-year debt cycle matters. These cycles aren't about recessions. They're about regime changes. They mark the transition from expansion to constraint, from flexibility to trade-offs. The last time this happened on a global scale was the mid-century after debt from wars, depressions, and structural imbalances forced a redesign of the financial order. Not overnight, over years. What makes the current moment different is scale. Public debt levels across advanced economies are now well above historical norms relative to economic output. Private debt hasn't meaningfully deleveraged either. It's shifted from households to governments, from visible balance sheets to implicit guarantees. The risk didn't disappear. It migrated. At the same time, interest rates have reset higher after years near zero. Even if they come down somewhat, they are unlikely to return to the ultra-low environment that defined the post-2008 era. Inflation risk has re-entered the system, and central banks can no longer pretend it's purely transitory. This combination changes everything. Higher rates plus high debt equals fragility, not collapse, fragility. Small shocks matter more. Timing matters more. Confidence matters more. This is exactly how new long cycles begin. Not with panic, but with tightening margins. Look at what's happening right now beneath the surface. Governments issuing more debt just to roll over existing obligations. Central banks signaling restraint even as growth slows. Fiscal policy doing the heavy lifting because monetary policy has lost room. These are late-stage symptoms of an old cycle and early-stage features of a new one. Another tell is behavior. Markets no longer react to good news the way they used to. Strong data doesn't rally assets. It raises fear of tighter policy. Weak data doesn't guarantee stimulus. It raises fear of stagnation. That inversion tells you the framework has shifted. In the old cycle, growth was always the solution. In the new one, growth competes with stability. That's the defining characteristic of a long debt reset. Governments face impossible trade-offs. Cut spending and risk recession. Spend more and worsen debt dynamics. Inflate and risk credibility. Tighten and risk defaults. None of these choices restores the old equilibrium. They only shape the new one. This is why calling this a coming cycle is inaccurate. The transition has already started. The evidence isn't a single chart. It's everywhere. Persistent deficits during expansionary periods. Rising interest. Costs despite strong nominal growth. Political resistance to austerity combined with voter fatigue over inflation. Supply chains redesigned for security, not efficiency. These aren't temporary distortions. They're structural adjustments. A new cycle doesn't mean immediate pain. It means slower growth, more volatility, and more frequent policy conflict. It means financial repression becomes normalized again. It means savers quietly lose ground while debtors gain breathing room. That's how long cycles rebalance without outright default through time, through erosion, through rules changing slowly enough that people adapt instead of revolt. This is also why asset behavior will look confusing. Traditional safe havens won't behave consistently. Bonds won't hedge equity risk the way they used to. Cash will feel safe nominally, but bleed purchasing power. Real assets will swing violently as policy signals conflict. The old correlations were built for the old cycle. They won't survive the new one intact. What replaces them isn't chaos. It's selectivity. Markets will increasingly reward durability over growth stories. Cash flow over promises. Balance sheet strength over narratives. That's exactly what happens at the start of a long debt reset. The system doesn't break, it hardens. And hardened systems don't move fast. This is the part people underestimate. A new 90-year debt cycle doesn't mean disaster tomorrow. It means constraints for decades. It means the era of effortless solutions is over. It means every policy choice now has visible losers. The post-crisis world trained everyone to expect rescue. The new cycle trains everyone to expect limits. That psychological shift is the real reset, not a crash, not a default, a repricing of what is possible. And that repricing has already begun. Once a long debt cycle turns, the most dangerous mistake is assuming the old rules will slowly come back. They don't. They fade unevenly. And the space between what used to work and what now works is where most damage happens. This is why the early phase of a new cycle is so deceptive. Nothing looks broken enough to force change. Markets still function. Governments still borrow. Growth still appears in headlines. But underneath, the mechanics are different. Capital behaves differently. Risk is priced differently. Time horizons shorten. This is where asset survival stops being about returns and starts being about resilience. In the old cycle, leverage was rewarded. Cheap money made debt look smart. Rollovers were easy. Growth projections mattered more than balance sheets. If something went wrong, policy stepped in. In the new cycle, leverage becomes a liability. Not immediately, gradually. Refinancing windows shrink. Credit spreads widen in places people aren't watching. Companies that depend on constant access to cheap capital start cutting quietly. Not because they're failing, but because the margin for error is gone. This is how fragility expresses itself. You won't see mass bankruptcies at first. You'll see fewer IPOs, fewer buybacks, more cautious guidance, more emphasis on discipline and efficiency. Those words always show up at the start of a long reset. Governments behave the same way. They don't announce austerity. They talk about prioritization. They don't say spending cuts. They say fiscal responsibility. They stretch timelines, extend maturities, change rules quietly. This is financial repression re-entering the system, not as policy, but as necessity. Rates stay below inflation just enough, just long enough to erode debt in real terms without triggering revolt. Savers feel squeezed. Debtors get relief. The transfer is subtle but relentless. That's how long cycles cleanse excess without blowing everything up. This is also why volatility becomes structural, not panic volatility, regime volatility. Markets swing between fear of inflation and fear of stagnation. Policy signals conflict. 1 month, easing looks inevitable. The next, it looks impossible. Assets reprick repeatedly as narratives flip. This is an indecision. It's a system searching for a balance that no longer exists. In the old cycle, growth absorbed mistakes. In the new one, mistakes compound. That's why diversification becomes harder, not easier. Correlations shift. Safe assets lose reliability. Risk assets lose forgiveness. What survives are not categories, but characteristics. Low leverage, pricing power, essential demand, strong cash flow, flexibility. What fails are structures built on assumption. Assumption of cheap refinancing. Assumption of endless liquidity. Assumption that time alone fixes balance sheets. Time is no longer neutral. That's the mental shift people struggle with. In a long debt expansion, waiting is rewarded. Assets rise with time. Debt shrinks relative to growth. Patience pays. In a long debt reset, waiting can be costly. Real values erode. Opportunities are episodic. Protection matters more than participation. This doesn't mean retreat. It means selectivity. It also means politics becomes inseparable from markets. Debt constraints force visible choices. Who pays? Who is protected? Who absorbs inflation? Who absorbs cuts? Those decisions can't be hidden behind growth anymore. As a result, policy volatility rises. Elections matter more. Policy credibility matters more. Market reactions to politics become faster and harsher. This feeds back into capital behavior. Money becomes more cautious, less global, more selective about jurisdiction, regulation, and stability. Not because globalization ends, but because it becomes conditional. That's another hallmark of a new long cycle. The old system optimized for efficiency. The new one optimizes for survivability. Efficiency is fragile. Survivability is expensive. This is why productivity growth may look weaker even as systems become more resilient. Redundancy replaces optimization. Slack replaces speed. Margins replace scale. None of this feels good in the short term, but it's how systems adapt when debt has run too far ahead of real capacity. And this is why calling this moment temporary is dangerous. Temporary implies return. This is transition. The last long cycle didn't end because policymakers chose differently. It ended because the structure could no longer support the assumptions it was built on. The same is true now. A new 90-year debt cycle doesn't promise collapse. It promises constraint. It promises fewer miracles. It promises slower, harder-earned progress. For people who built strategies in the old world, that feels like loss. For systems that survive the transition, it's stability at a lower altitude. The mistake is expecting the sky to come back down. It won't. The ground is rising instead, and everything is adjusting to that fact whether it admits it yet or not. At the individual level, this is where the new cycle stops being theoretical and starts becoming personal, because long debt cycles don't change the world all at once. They change incentives, and incentives shape behavior long before outcomes are obvious. The biggest mistake people make at this stage is assuming an action is neutral. It isn't anymore. In the old cycle, doing nothing often worked. Holding assets, letting time pass, letting growth and liquidity do the heavy lifting. Even mistakes were forgiven by rising markets and falling rates. In the new cycle, time itself becomes a cost. Inflation doesn't need to spike to punish passivity. It just needs to persist, slowly eroding purchasing power, while nominal values create the illusion of stability. People feel like they're standing still when in reality, they're sliding backward. This is why the new cycle quietly reshuffles winners and losers without dramatic events. Winners aren't the most aggressive. They're the most adaptable people and institutions that can adjust cash flows, expenses, and exposure as conditions change. Those who aren't dependent on constant refinancing or policy rescue. Losers aren't reckless either. Often they're disciplined by old rules. They save diligently in instruments designed for a world of low inflation and high trust. They follow advice that worked for decades and suddenly doesn't. That betrayal feels personal. This is where frustration turns into confusion. People do the right things and still fall behind. Not because they failed, but because the framework shifted underneath them. Long cycles always produce this moment. The system stops rewarding virtue the way it used to. It starts rewarding positioning. That's uncomfortable to admit, but it's how transitions work. You can see it already. Income matters more than appreciation. Liquidity matters more than yield. Flexibility matters more than optimization. Security matters more than scale. This isn't pessimism. It's adaptation. Institutions adapt first, then markets, then individuals. The lag between those layers is where inequality widens and resentment grows. That's why this phase feels unstable even without crisis. People sense the gap. They know the system is changing, but they don't yet know the new rules. So, they cling to old ones harder, hoping familiarity will protect them. It won't. The hardest lesson of a long debt reset is that stability comes from alignment with reality, not loyalty to tradition. That doesn't mean constant trading or panic. It means awareness, adjusting assumptions, understanding that real returns matter more than nominal ones. That risk isn't just volatility, it's erosion. The new cycle doesn't eliminate opportunity, it redistributes it. Opportunities become more episodic, more localized, more dependent on timing and structure than broad participation. This is why blanket advice becomes dangerous. What works in one sector fails in another. What protects one group harms another. There is no universal hedge anymore. That's a feature, not a bug. The system is forcing differentiation. And that differentiation is how excess debt slowly unwinds without default through uneven outcomes, through quiet transfers, through time. That's the final thing people miss about long debt cycles. They don't end with headlines. They end with acceptance. Acceptance that growth is harder, that margins are thinner, that stability costs more, that some promises made in the old cycle can't be kept in the new one. Once that acceptance sets in, behavior changes permanently. Spending becomes cautious. Borrowing becomes selective. Risk becomes contextual. Expectations reset lower. That's when the cycle truly locks in. Not when markets crash. When people stop expecting rescue and start planning around limits. That's the moment a new 90-year debt cycle stops being a theory and becomes the environment everyone lives in.